SoFi reported earnings before the market opened on Tuesday and really beat expectations across the board. Revenue, earnings per share were better than expected. They increased guidance for the full year. This is becoming much more of a technology company than they are a bank. That's one of the things that I think is interesting in looking at this stock is a lot of investors still think about this as a banking company. It was only a few years ago that a vast majority of the company's revenue was coming from its lending business. That lending business really relied on personal loans and student loans, so very high risk segments of the market. But that has transitioned now. Nearly 50% of the company's revenue is now coming from its technology platform and financial services. So I want to dig into where the growth is coming from, where they're being a little bit more conservative, and why this is still, I think, a company that has a very long runway of growth. The quarters are going to be choppy. There was a little bit of choppiness in this quarter, a little bit of weakness on that technology side. But there was phenomenal growth, 80% growth in financial services. So I want to dig into exactly what investors need to know. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right into the earnings report. This is the Q2 2024 results summary. And we'll go down here. The first thing that they always talk about is the number of members. And this is not necessarily what's going to drive revenue or earnings, but it's going to be a proxy for how well is the business doing? How many people are attracted to SoFi as a banking company, as a platform? So you can see that the number of members has grown from a little over 1 million in Q1 2020 to now nearly 9 million in Q2 2024. So they are steadily pulling customers from traditional banks onto this digital first banking platform. They put this in a couple of different ways. Down here, the dark blue number is the year-over-year growth. So we're still growing the number of members at over 40%. And then this light blue number is the number of incremental customers that are added. So the growth rate is slowing, but the number of absolute customers that are being added is actually increasing over time. So great trends from a number side. This should, again, be a proxy for that long-term growth because a member is going to join and they're going to maybe join because of a high rate savings account. Then eventually they're going to add investing and maybe they're going to take out a personal loan or maybe a mortgage in the future. So the long-term value is going to be realized over the course of many, many years, but this is going to be kind of the number of people coming in the door. The number of products, again, this is kind of a strange metric, but it's just how many loans are outstanding, how many financial services products are the company, how many financial services products are people adopting, so how many credit cards or debit cards, things like that. So you can see that there are nearly 13 million products with another nearly 1 million added in the quarter, up 36% from a year ago. Galileo is going to be more of their technology side, that technology platform side of the business. You can see that slowed down a little bit in early 2023, now starting to pick up again. 23% growth. That's their best growth rate that they've had since the end of 2022. So that's what you want to see. And this is a little bit like the member number, but it's more business partners. So you aren't going to necessarily go out and sign up for a Galileo account, but a company that you work for may have a Galileo account with SoFi that you then have an account or a credit or debit card associated with that. So that's why these numbers are so big, 158 million Galileo accounts, and those will generate more revenue over time. So we're not necessarily seeing the impact of this recent growth, but we will see it over the next few years. Lending and financial services. Lending is something that SoFi has really pulled back on over the last year, and management has done this intentionally. They have said, hey, we want to take a little bit less risk on the balance sheet, have a little bit less interest rate risk, especially as a lot of banks were predicting multiple interest rate cuts earlier in the year. I think that was one of the interesting things with their conference calls earlier this year was CEO Anthony Noto basically said, hey, look, if we have 6 interest rate cuts, that means that the economy is doing terribly. We're not going to build our business around 6 interest rate cuts. So they built the business around more like 1 to 2 interest rate cuts in 2024. It looks like that's probably where we're headed, or at least close to where we're headed. So it's put them in a pretty good position. But the number of lending products up 19% year over year. I'll show you that the revenue in that segment is not growing. And that, again, is intentional. Financial services products, these are going to be more ongoing revenue. So that was up 39% year over year. So financial services was really the growth driver in the quarter. And this is just trying to show that flywheel of productivity growth on the financial services side. People may start with a home loan or student loans or a personal loan, Then they're going to end up with a credit card, investing products, relay, and then money as well. So checking and savings. They're really moving from kind of those higher risk lending products to more traditional banking services. And that's really what you see with this financial services loop. They talked a lot about the risk profile of their lending business. Again, this is one of the things that analysts are really focused on because they're looking at this more as a banking company. But if you pull back overall, you can see that revenue, $597 million. And again, that was because lending was down a little bit. But what you're seeing is the business heading in the right direction, at least from a year-over-year basis. And again, I'll get to some of those lending metrics in just a second. But that's the big reason that revenue in particular is not growing right now. This was their guidance versus actual performance. You can see this was given 3 months ago. They expected $555 to $565 million in revenue, actually reported $597. So a big beat on the revenue side of things. Pretty significant beat on adjusted EBITDA as well, and the adjusted EBITDA margin. Net income was also more than double what the midpoint of their guidance was. For next quarter, they're expecting things to get even better. Again, net income goes from $17 million to $40 to $45 million. That drumbeat of increased profitability continues to take place at SoFi. Revenue expecting to grow to $625 to $645 million. That is up at the midpoint 20% from a year ago. So continued growth in that business. And again, remember that management has beaten those expectations pretty regularly, so wouldn't be surprised to see numbers be even a little bit higher than that. This is what they expect for the full year of 2024. And you see the one that pops out to me is net income, solidly profitable. And this actually puts the current valuation of the company at 43 times earnings. So still a pretty high multiple. But again, you're focused on this being a growth company, a company that's growing around 20%. It's not unreasonable to pay that kind of multiple for a company that's growing that quickly and also has operating leverage in their business. That's really the key, is that they've really just gotten to profitability. That profit should continue to grow at a much faster rate than revenue does. The other thing from guidance, this assumes a 50-50 revenue split between lending and the combined tech platform and financial services. So again, 5 years ago, this was basically 100% a lending business. Now it is 50-50 a tech and financial services business. So maybe we should think about the way that we're valuing the company a little bit differently, given that that is going to be more than half of the business, probably as soon as 2025. So these are the segment numbers, and this gives a little bit more context into what's going on from a revenue and profit standpoint. You can see this is what I want to focus on first, is the lending segment. This is this first section on the top. You can see that revenue grew a little bit this quarter, 339 from 322 a year ago, and contribution was up just a little bit. But again, this is not a business that's growing at a significant amount. Last quarter, it was actually flat, and they have really pulled back on the amount that they have been giving out as far as loans go. Things are a little bit volatile, but they're moving more into things like home loans. So going to be a little bit lower interest rate, also a little bit lower risk profile because there is an asset backing that. Student and personal loans did pick up in the most recent quarter, but they were much more conservative on that in the first quarter. So management did say if interest rates start to come down, they could take a lot of market share in both of those segments. Technology platform, I discussed the revenue growth there and also the contribution profit growth. That contribution profit nearly doubled from a year ago. And then financial services, this is going to be all of the myriad of financial products that the company has, from banking to investing to IPOs to credit cards. And this revenue was up 80% in the quarter, turned from a contribution loss a year ago, $4.4 million, to a contribution profit of $55.2 million. So I think everything is moving in the right direction for SoFi. It's not going to be a straight line up, but what you want to see is growth in the technology business and the financial services business. And that's exactly what we got in this quarter. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, obviously, the market's reaction is not particularly positive. Shares are about flat as I'm recording on Tuesday, but that's not all that surprising. You don't have any really eye-popping numbers. It was an earnings beat, but just a small earnings beat for SoFi, so not surprising that the stock isn't up 10 or 15% today. But what I think we are seeing is continued momentum in the business. Financial services and the tech platform, those are the two areas that you want to see growth. Of course, if they were able to Of course, if they're able to grow the lending business, that would be a positive, but there's going to be more operating leverage on the first two segments. So that's where I want to see growth. That's where I want to see the differentiation in the business. They're able to scale that business without the capital that it needs to grow the lending business. So a little bit different business models there. But that's where I see the ultimate upside is. This is going to be a disruptive company because it is a digital company first. It's not just a bank. So it's a little bit strange the way to think about it. Do you think about it like a fintech? Do you think about it like a bank because they do have loans on the balance sheet? It's a little bit of both. That's why I'm not uncomfortable paying the current multiple. But management has such a big vision for this company that I'm just going to continue to add if the share price doesn't go anywhere, or if the stock starts to drop, because I think this is such a transformative company and such a disruptive company in the financial space over the next 10 to 20 years. I'm going to much rather be in a company like SoFi, who is aggressive in growing and adding customers, than in a traditional bank. So that's the way I'm looking at earnings today. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.